Hi everyone. Today we are going to discuss about double entry bookkeeping system. Now in previous videos we learned about financial accounting. We learned that it's a process where we transform transactions and events, which is our input, and we convert into an output called financial statements. In this process we have a couple of main steps that we need to follow. The first step is to enter into the prime books. And once we record all the transactions and events in the prime book, we need to record into a proper system. We call this ledger. Now, ledger is a special component in financial accounting. It is the most systematic approach that we see recording transactions of the organization. In order to do that, we use a special system we call double entry system. Now, what is a double entry system? In a very simple context, double entry means two entries of two effects. What is this two effects or two entries? Debit entry or the credit entry. So it says every transaction has a debit entry and a credit entry. So this ledger, it is a shape of a T letter. So therefore we call T account. Now let us understand this transaction into the ledger. Before that, I'm sure you can remember the accounting equation. This is the accounting equation. As you can see here, we have assets, expenses in one side, we have capital, liabilities and income in another side. So here we call the debit side. All these accounts have balances of debit. So all the T accounts, all the ledger accounts of assets and expenses must have a debit balance, whereas capital, liabilities and income should have credit balance. So at the end of the transaction, always the total debit balances must tally to total credit balances. So there are some very important rules that we need to know in double entry system. So let's try to understand that. If I may write in, so these are the ledger accounts. Because it's a T letter shape, we call T accounts. So let me write the accounts here. Right. As you can see, now we have 5 T accounts. Each has a heading: asset, expense, capital, liability and income. So as I told you, the accounts in this side, assets and expenses, should have debit balances. So I will write brought forward of assets in the debit side, expenses also in the debit side. Whereas the capital, liability and income should have credit balances. So the brought forward balances would be credit. Right. Therefore, the first rule, if I want to increase an asset or an expense, because my balances are in debit side, if I want to increase, I need to debit. So if I want to increase, I need to debit assets and expenses. At the same time, if I want to increase capital, since my balance is in credit side, I need to credit it. So my increase here, credit. Same as liability and income. If I want to increase, I need to credit. Right. Now, if I want to reduce the asset, since my balances, if I debit, it will increase, I need to credit that account. So therefore, if I want to reduce, I need to credit. Same as if I want to reduce an expense, I need to credit. So since if I want to increase a capital, I credit. Now if I want to reduce the capital, I need to debit. Decrease. And same as if I want to reduce a liability, I want to debit. And if I want to reduce an income, I need to debit. So these are the fundamental rules in accounting where we must know before we enter any transaction into the ledger. So you got to be very clear about this rule. Rules are very important for you to prepare the accounts. So like I said, refresh. Asset and expenses has debit balances. So if I want to increase those balances, I need to debit. Capital, liability and income has credit balances. So if I want to increase, I need to credit, credit, credit. However, if I want to reduce these balances, I should debit, debit, debit. But when it comes to assets and expenses, if I want to reduce, I should credit those because it's against the debit balances. So let's try to apply this into day-to-day transactions. So let's start with the first transaction. The owner is introducing money to the business. Now to do this, first I'm trying to explain you the effect for the accounting equation, and then I'm trying to put it into the double entry system. So let me first write the transactions and then I will write the effect. Okay, the first transaction, the owner introduced capital 100,000 to the business. What is the accounting equation effect for this? The equation effect is asset is increasing because the organization assets of cash is increasing by 100,000. This is cash. On the same time, the owner's contribution also increases by 100,000 and we call capital or equity. Now we are clear about the effect, and these two effects will make sure the equation tallies. Let's put it into the ledger. Now you know if you are going to increase an asset, you are going to debit it. If you want to increase the capital, we need to credit it. So if I may write this transaction, the cash will increase, so it's going to be debit, and the capital also increasing, so it's going to be credit. So what would be the double entry system? The two entries would be, I will write the first one, the cash will debit by 100,000. The capital account, because it's crediting, because it's increasing, I will write capital credit 100,000. So let's write another transaction. So business purchased furniture for 25,000 by paying cash. So what is the effect here? When you purchase 25,000 of furniture, you're going to get a new furniture called 25,000 asset of furniture. However, on the same time, you are utilizing your cash and that's your business. So therefore, your cash is going to reduce by 25,000. So you can see where a one side transaction, the two entries are on the same side. So one asset increases, another asset decreases. So if I put it into here, so you can see a one asset increasing, which is the furniture. So your furniture is going to increase and the cash is reducing. So cash is also reducing, it's a decrease. So we can write the equation as furniture account debit, because it's increasing, we debit 25,000, cash account credit 25,000 because it's reducing, it's going by the row. Let's understand another type of transaction. Okay, so let's try to put it to the equation. Now again here you can see when you purchase stocks, what will happen? That's an asset. So your stocks will go up by 10,000. On the same time, you are paying by cash and your cash is reducing by 10,000. So if I apply to this rule, your asset increases, your stock, so their stock account increases, so you debit 10,000. On the same time, you reduce one of your assets is cash, so your cash account credit 10,000. So you record that as well. So if I put it into the ledger, if I show this into the ledger, you have the asset account of cash on one end and we have a stock account from the other end. So if I show you the cash account here and the stock account here, your stock would be debit, so you write 10,000, and your cash is crediting, so you write 10,000 to the credit side. But the most important thing is you need to write the cross reference name. The corresponding name for cash account is stocks. So you got to write here stocks, and for the stock account it's going to be cash. So then when you're reading the transactions, it's clear that okay, in the cash account, stocks means you have purchased stocks of 10,000. And if you have the dates, you should write the date also in front. Right, okay, so let's try to understand another transaction. The more you learn these different examples, you will be comfortable. So if you go to the next transaction, so let's try to put this. Right, okay, the transaction is goods sold on 5,000 on cash and the cost of the sale was 3,500. How are we going to record this transaction? First of all, we know that when we sold goods, definitely our cash is going to go up, and that is increased by 5,000. On the same time, it's an income for the business, so therefore your sales will go up by 5,000. So what about the effect of this? 3,500 is the cost of the sale. So we treat this cost of the sales as an expense, which is going to be increasing by 3,500. On the same time, our stocks is going to reduce by 3,500 because the inventory is reducing because of the sale and the cost of the inventory is 3,500. So we can record these transactions now into the ledger. Now we know the rules here. The cash is increasing by 5,000, so it's increasing. So if I may write the double entries, the cash is debit by 5,000, and on the same time my sales are increasing. Because the sales are increasing, it is a credit balance, so therefore sales account will credit 5,000. And if you look at the cost of sale, which is an expense, so expense is increasing, would be debiting. So cost of sales account, if I debit, I do the 3,500, which is my cost, and my stocks is reducing, so my stock account will reduce by 3,500. So these are the four effects that I can see in my ledger. So if I may show this into the ledger accounts, I can open cash account. So my cash would go up by 5,000 and my income would go down. Sorry, income will credit by 5,000. So I'll write here cash and I'll write here income or the sales account. On the same time, I have cost of sales account where my cost of sales and my stock account. So if I say cost of sales, it will increase by 3,500 and my stocks account or the inventory account is reducing by 3,500. So I'll write here cost of sales and I write here stocks. So you can see the four entries into the ledger. So this is a good example where we record a cash transaction where you have a sale price and the cost of sales into the ledger. Right, look at this transaction. Another example. Business purchased 50,000 goods on credit. So let's first quickly understand the effect. The moment you purchase stocks, your stocks is going to go up by 50,000. And because we are purchasing on credit, we have to pay them. So it's a liability. And we are increasing our liability. So our liability, from the other hand, is increasing by 50,000. We call accounts trade payables. So the trade payables went up 50,000, stocks also went up by 50,000. So if I put it into the ledger, because the stock is an asset and the asset is increasing, you see your stock account debit by 50. And your liability, which is a credit balance where it is increasing, you need to credit it. So trade payable would credit 50. And if I put it into the ledger, I see my stock account is increasing by 50,000 and my trade payable is increasing by 50,000. And the corresponding account, I will write here trade payable. And here I will write stocks. Another transaction. Business paid rent $2,000. Let's first record the effect. When you pay rent, we know that the cash is going to go down by 2,000. And rent is an expense. So increase of an expense, you can see the rent is going up by 2,000. So if I put it into the double entry, increase of rent, which is an expense. So rent account, rent expense account would debit 2,000 and the cash is reducing. So cash account would credit 2,000. If I may put it into the ledger, I have a cash account where I will credit because I'm paying. On the other hand, my rent expense is increasing by 2000. So I will write here rent and I'll write here cash. Okay. Right. Now you can see another transaction. Business sold 15,000 on credit and the cost of sale is 10,000. So let's first put it in the accounting effect to the equation. So here you can see you are selling 15,000 goods. So you are not receiving cash, right? And we know that the income is going up by 15,000. So let's write what we know, increasing in income by sales of 15,000. Even though we don't receive cash, we are going to receive money in the future. So we give a special asset name for such credit sales, trade receivables. So it's an asset. So assets of 15,000 increases, but it's not cash, it's trade receivable because we are going to receive in the future and we treat it as an asset. So that's the first entry for the 15,000. How about 10,000? That's the cost. So when you make a sale, whether it's a credit or cash, your inventory, your stocks is going to go down by that amount, and that is 10,000 a reduction. And at the same time, we identify the expense, the cost of sale is going to go up by 10,000. So if I may put it into the ledger, what is the effect of that? My trade receivables are going to go up. So my trade receivables is debiting 15,000 because it's an asset. So I will open a trade receivable account. I can see a 15,000 increase. On the same time, I see a sales account or a sales or an income account where I'm going to credit because sale, I'm going to increase my sale by 15,000. So my sales account would credit 15,000. I'll write trade receivables here and here I will say sales. So if I may show the cost effect, the cost is increasing by 10,000. So it's an expense. So cost of sales account is increasing by 10,000. And on the same time, my stocks is reducing by 10,000. So an asset account of stocks is going to reduce by 10,000. So I'll write here cost of sales and I'll write here stocks. So in credit, the only difference you can see from cash sale, you will find trade. Let's learn about the next transaction. Sales return of $1,200. Cost of sale is $800. Now when businesses are making cash or credit sales, because of many reasons, the stocks are going to be returned. So sales are going to be returned. So if that happened, how are we going to record into the ledger? So to understand, you need to be very clear about the sale and the cost of sale on a cash or credit basis. So here the assumption is we are making on a cash basis because it doesn't specifically say it's credit. So if I take it as a cash sales return, what is going to be the effect for the accounting equation? So sales is returning, which means we have to pay back the money. So the first thing that we need to do is cash is going to reduce by that value. At the same time, income is also reducing. So when the income is reducing, we know that if it is an income is reducing, we need to debit it. So here we call sales returns and that is going to reduce by 1,200. So at the same time, cost of sales, we are receiving our stocks back. So our stock account will increase by 800. The cost of that sale was 800. And whatever they identify as an expense before, now we need to reverse because the stocks are coming back. So we are reducing the cost of sales by 800. So let's try to put it into the ledger. So let me first write the double entries and we'll put it into the ledger. So the cash is reducing, so we credit 1200. I'm sure we are clear. And the sales return, it's a special transaction. Now it is an opposite of a sale. So you can see here a sale is increasing of a sale is credit, but it's a reduction. So reduction is a debit. So sales returns going to be debit 1200. That we reflect 1200, and the cost of sales stocks is increasing, so we debit 800. On the same time, when the cost of sales is reducing, you need to credit the cost of sales. So if I put it into the ledger, I can see the cash account where I'm going to pay, so therefore 1200 credit, and I see a sales return account where I'm debiting 1200, and then I can see the stock account is debiting 800, and I see my cost of sales is crediting 800. So here I will say stocks, here I will say cost of sales, and here this is about the sales returns, and this is about cash. So cash is reducing, sales returns are increasing, stocks increases, cost of sales reverses. Let's learn about the next transaction. Owner took 2500 from the business. Sometimes when the owner takes goods or cash from the business, and in the business entity concept we believe the owner is different to the business, we need to record this. We give a special word in such situations as drawings. So here, how do we account for the drawings of 2500? So when the owner took 2500, it's on terms of cash, the cash is going to reduce by 2500. And whatever the amount that we have identified as capital also going to go down by 2500, and we give a special word drawings. So cash reducing means cash account credit 25, and the drawings, you know, this capital increasing means credit, decreasing means debit. So therefore drawings account we debit 25. So if I put it into the ledger, we have a drawings account where we debit 25, and we have a cash account where we credit 25. And so here we say drawings, and here we say cash. Right, let's learn another transaction. Business obtained a bank loan $50,000. So when the business took a bank loan, what is the effect to the accounting equation? So obviously we are receiving money, so your cash is going to go up by 50,000, and we have to pay that. So we are going to create a liability called business the bank loan of 50,000. So if we put it to this effect, so cash is going to debit by 50, and the bank loan, because it's a liability and we need to increase that bank loan, we are going to credit 50,000. If I put it into the ledger, cash I'm receiving 50 bank loan, because I'm increasing the bank loan, I'm crediting 50,000, and here I would say cash, here I would say bank. Another transaction, business is purchasing a building for 50,000 cash. So if we put it to the accounting equation, the 50,000, a new building, an asset, will create. On the same time, you are reducing your cash by 50,000. So the double entry would be building account will increase by 50,000. So you debit it because asset is increasing. On the same time, because the cash is reducing, we credit the cash by 50,000. So the account would be 50,000 and the cash account would be 50,000. So here we say cash and here we say building. Okay, let's learn this next transaction. Business received rent income of $10,000. How can we record this into the ledger? First, we need to understand the accounting effect. So when we receive 10,000, the cash will go up by 10,000. And because this rent is an income, so the income will increase, the rent income to be increased by 10,000. So the effect would be the cash increase. We know it's an increase of an asset, so we debit 10,000. The rent income is an income account, so increase in the rent is credit. So therefore, rent income would be credit 10,000. So if I put it into the ledger, I will have cash where I'm receiving cash of 10,000 and we say rent, and the rent income account would credit 10,000, we call the cash. So these are some of the common transactions which are affecting a business. So knowing all these transactions would be able for you to get a confidence on recording any type of a transaction in an organization.